Wherever you are around the world, I highly welcome all of you to AE Accounting Tutorials. We are continuing our series on IFRS 16 leases. Today I'm going to take you through a tutorial question where lease payments are made in arrears. That is where lease payments are made at the end of the financial year by the lessee. Okay, so we are going to look at accounting arrangements where lease payments are made in arrears. But remember that we've taken a question in our previous video where lease payments are made in advance. That is where lease payments are made at the beginning of the financial year. Okay, so before we go through the question, I will encourage you to subscribe to this channel, turn on the notification bell so that anytime I upload any new video, you get notified. So let's go through the question together. A Bay Company Limited entered into a lease agreement with Sronipa Machinery Limited on 1st January 2018 for a new bottle washer plant tagged with a cash price of 118,650 Ghana cedis. The lease requires the payment of an annual rental of 34,025 Ghana cedis payable in arrears. The primary period of the lease is for 4 years, after which the lessee has the right to extend the lease indefinitely on the payment of a nominal annual rental. The lessee holds the view that the economic useful life of the plant is 4 years and depreciate it on that basis on cost with now residual value. The implicit rate of interest in the lease is 5.725%. Both the lessee and the lessor have accounting period ended 31st December. The finance charge is accrued at 31st December. Required: A. Show the allocation of finance charge using actuarial method. B. Show the charges to the statement of profit or loss extract in respect of the lease over all relevant years. C. Show the statement of financial position extract for all relevant years. Alright. The key things you have to take note in this question is that the lease term begins on 1st January 2018 and the cash price of the plant, that is the initial liability, is 118,650 Ghana cedis. The annual rental payment is 34,025 Ghana cedis payable in arrears. This means that payments are made at the end of the financial year. Is that okay? And the implicit rate of interest in the lease is 5.728%. Good. To begin with the requirements, the first requirement says that shows the allocation of finance charge using actuarial method. Okay, so to determine our finance charge, it is being done at a subsequent measurement by the lessee. Okay, so we are going to determine the finance charge using the actuarial method. From this question, even if the question didn't ask us to use the actuarial method to determine the finance charge, we should know that there is an implicit interest rate in the lease, which is 5.728%. Okay, so anytime there is an implicit rate of interest in the lease, it means we are using the actuarial method. This method is highly accepted by the IAS standard. Is that okay? So in subsequent measurement, we are going to prepare a schedule of lease payment and finance charge. Okay, by this time we are using actuarial method where a constant interest rate implicit in the lease is used to determine our finance charge. Is that clear? Okay, but take note that the lease payments are made in arrears. Okay, that is where lease payments are made at the end of the financial year. Okay, so this is how the schedule look like. We consider the period, that is the lease term. Then we consider the liability at the start of the period. Okay, that is the initial liability. Okay, at initial recognition. Then after that, then we consider the finance charge. We are going to use the interest rate implicit in the lease to determine our finance charge. Okay, so we are going to apply the rates on the opening liability or the liability at start to determine our finance charge. After that, then we add the finance charge to the initial liability to arrive at our liability during the period. Okay, after that, then we subtract our rental payment from the liability during the period to ascertain our liability at the close or at the end of the period. Is that clear? So basically this is how the schedule look like. But remember that if it were payment to be made in advance, then the rental payment would have been here and the finance charge would have been here. Is that okay? Good. So that is the dynamics. So to begin with the subsequent measurement by the lessee, we are going to start with the liability. Okay, at the commencement date, we are going to recognize the liability by the lessee. Okay, so the liability is given to us straightforward in the question. That is the cash price that is tagged with the plant. Okay, that is 118,650. But remember that the lease term is for 4 years and it begins on 1st January 2018. So we have 2018. Okay, and the initial liability is 118,650 Ghana cedis. So we are going to determine the finance charge by applying the interest rate implicit in the lease on the liability at the start of the period, and that is going to give us 6,796. Okay, I'm rounding this number to the nearest whole number. Okay, so to determine the liability during the period, we add the liability at the beginning of the period to the finance charge, and that is going to give us 125,446. Okay, now the rental payment in the question is 34,024. Okay, that is the annual rental payment, and that is fixed. Okay, so 34,025. Okay, we are putting this in bracket because it is an outflow of cash. Is that clear? So now to determine the liability during the period, we take the rental payment from the liability during the period, and that is going to give us 91,421. Okay, you have to understand that the liability at the close of 2018 becomes the opening liability for 2019. Okay, so when we get to 2019, the closing liability becomes the opening liability over here. So that is 91,421. Is that clear? And we are going to apply the interest rate implicit in the lease, that is 5.728% on the opening liability. That is going to give us 5,237. Okay, so to determine the liability during the period, we add these two. Okay, and that is going to give us 96,658. Okay, now the annual rental payment is constant. Okay, so 34,025 Ghana cedis. Okay, so we take the annual rental payment from the liability during the period to arrive at the liability at the close of the period, and that is going to give us 62,633. So the liability at the close of 2019 becomes the liability at the beginning of 2020. Okay, so for 2020, that is 62,633. Okay, we apply the interest rate implicit in the lease on this opening liability. That is going to give us 3,588. Okay, and to determine the liability during the period for 2020, we are going to add the two. Okay, that is going to give us 66,221 Ghana cedis. Remember that the rental payment is still fixed. Okay, so to determine the liability at the end of the period, we are going to subtract this from this, and that is going to give us 32,196. Is that clear? Good. So we move to 2021. The closing liability here will become the opening liability over here. That is 32,196. We apply the interest rate on this. That is going to give us, I think that is going to give us 1,844.18. Okay, but I'm going to do round off in order to make sure that there will be no liability at the close of the period. Is that clear? We are doing this because when we take the rental payment, there shouldn't be any closing liability. Okay, because payments are made in arrears for 4 good years. Okay, afterwards there will be no closing liability. Okay, so first of all, let's determine the constant rental payment. That is 34,025. Okay, it means that the liability during the period should be the same as this amount, so that there will be no closing liability. Okay, so to do that, it means this amount is also going to be 34,025 Ghana cedis. Okay, so we have to ask ourselves, how much should the interest rate implicit in the lease should be in order to add up to get this? That is going to give us 1,829. Okay, the reason why the interest rate implicit in the lease, when you calculate on this, you will not get this. You'll be getting 1,844.18. okay, just because of the round off I've did. Okay, so I've rounded it off. So basically, this is how we prepare the schedule for lease payment and finance charge when we are using a constant interest rate being implicit in the lease by the lessee. So we are done with the first requirement. So with the second requirement, it says that we should show the charges to the statement of profit or loss extract in respect of the lease over all relevant years. Okay, so let's see how we do that. With the second requirement, we are showing the statement of profit or loss. Okay, so the only items that is going to enter into this account are the finance charge and that of the depreciation charge. Okay, so to determine the finance charge has already been determined with the schedule. Okay, so we have our finance charge. Okay, so we have our finance charge. We are going to indicate the finance charge according to the years. Okay, so you can see that from the schedule over here. That is 2018. The finance charge is 6,796 in that order. So we are going to present this finance charge in the statement of profit or loss. Okay, so we have 6,796 for 2018, 5,237 for 2019, and we have 3,588 for 2020 and 1,829 for 2021. Okay, now let's determine the depreciation charge. With the depreciation charge, we are going to spread the cost of the plant over the lease term. Okay, and the cost of the plant, that is the initial liability of the plant, is to determine that depreciation is going to give us the cost, that is 118,650 divided by 4 years. Okay, the lease term, and that is going to give us an amount of 29,662.5. that is annually. Okay, Ghana cedis. So every year, this is the depreciation charge. We spread it over the 4 years. We are going to represent each year's depreciation by 29,662.5. 29,662.5. We have 29,662.50. 29,662.50. So because this is an extract, we are done with the statement of profit or loss. Okay, so now we are going to move to the requirement C. That is where we are going to prepare the statement of financial position extract as well. So with the requirement C, that is the statement of financial position extract. The leasehold plant is under property, plant and equipment. Okay, that is PP. Okay, that is PP. Is that clear? So under the PP, we have leasehold plant. Okay, and the cost from the question is 118,650. Okay, so the cost will be constant throughout the year. So 118,650, 118,650, 118,650. So we are going to consider its accumulated depreciation as well. So accumulated depreciation. Remember that each year the depreciation charge is 29,662.50. Okay, so we are going to have 29,662.50 for 2018. So we are accumulating the depreciation. Remember that for 2019 it was the same thing. So we are going to add the previous depreciation, that is 2018 to 2019, to accumulate it, and that is going to give us 59,325. Is that clear? As the accumulated depreciation for 2019. And remember that for 2020, its depreciation, annual depreciation, is the same as this. So we are going to add it to this to get its accumulated depreciation, and that is going to give us 88,987.5. Okay, and the annual depreciation for 2021 is also 29,662.5. So we add it to this, and that is going to give us 118,650 as the accumulated depreciation. So to determine the net book value, okay, so to determine the net book value, we take the accumulated depreciation from the cost of the leasehold plant, okay, and that is going to give us 88,987.5. okay, and this is going to give us 59,325. okay, and this is going to give us 29,662.5, and there will be net book value for 2021. okay, so now let's also consider the liability aspect. So now we are going to determine the liability. Okay, the liabilities. Okay, that is obligation under finance charge. Okay, another finance charge, or under right of use asset. Okay, so with the liability, we are going to split it into current liability and non-current liability. Okay, but you can still present it as one as total liability, but it is always prudent for you to split it into current and non-current. So we have current liabilities, we have the non-current liabilities. Okay, before we split it, okay, it will be very good for you to determine the total liability for the period before you split it into current and non-current. So we are going to determine the total liability for each year. Okay, total liability for each year. So to determine the total liability, you will go back to the schedule you've prepared. Okay, that is the schedule for lease payment and finance charge under the actuarial method. Okay, so you can see that the total liability at the close of the period for 2018 is this, for 2019 is this, and for 2020 is this, and there is no liability at the close of 2021. So we are going to present this as total liabilities before we split it. Okay, so let's come and represent them over here. So we have 91,426.21 for total liability for 2018, and 62,633 for 2019, and for 2020 is 32,196. There is no closing liability for 2021. And now we are going to split it. Okay, so in order to do the splitting, this is quite tedious, so just have a look at it as I do it. Okay, so if this is the liability at the close of the period for 2018, and at the end of the 2019 it becomes 62,633, it means there has been a current liability, or a liability that has been paid within one financial year. That is why the amount has been reduced. So to determine that, we take this, the liability at the close of 2019, from the liability at the close of 28, and this gives us the current liability for 2018. So we take this from this. Is that okay? And that is going to give us 28,788 as the current liability for 2018. So if current liability is this, then the non-current liability, we take this from the total to get the non-current liability, and that is 62,000 633. So to determine the current liability for 2019, we subtract the closing liability for 2020 from the closing liability for 2019, okay, to determine the current liability for 2019, and that is going to give us 30,437. Okay, so if this is the current liability, then the non-current liability, we take this from this to determine the non-current liability. That is 32,196. Okay, now we are to determine the current liability for 2020. Okay, so if current liability and non-current liability gives us the total liability, okay, in order to determine the current liability for 2020, what we are going to do is that we take the closing liability for 2021 from that of 2020. And there is no liability at the close of 2021, so the difference here still remains with this. Okay, so the current liability for 2020 becomes 32,196, and there is no non-current liability. Is that clear? So this is how we split the total liability into current and non-current liability. Okay, so this is how we do an accounting arrangement by the lessee where payments are made in arrears. That is where payments are made at the end of the financial year. But the questions we've solved, the two questions we've solved on payment in advance and payment in arrears, the initial liability of the asset has been given to us straightforward. Okay, so in our subsequent videos, we'll be taking questions where the liability or the price of the asset is not given to us straightforward in the question. Okay, so we will be doing a calculation to find it. Okay, that is where we will do initial recognition to determine the initial liability and the right of use assets. Sometimes we may use the annuity concept to determine the lease liability. Okay, so you just subscribe to this channel, turn on your notification bell, share, comment, and also like this video. Until we meet, I think bye for now.